Historically low unemployment, high consumer confidence, inflation in this country is easing faster than it is in other parts of the world. There are parts of the electorate that don't feel that, and they're not seeing it. So President Biden has to find a way to sell his agenda, to soften a lot of the discontent, the disillusionment, the questions about his age. Bottom line, though, I can tell you that campaign officials believe that if it's a choice between Donald Trump and Joe Biden, voters will break for Joe Biden because of Donald Trump's authoritarian impulses, the GOP's position on abortion. That might not show up in the polls, but it has shown up. It's been borne out in previous elections.
Jem, what about that? I mean, how concerned are you? Heard Congressman Dingell say, hey, I sounded the alarm bells in 2015 and 2016, and I'm sounding them again.
Yeah, look, I think that if you're in the Biden campaign right now, you need voters to feel a couple of things. One, you need them to be scared of Trump being reelected. It's actually good for them, for these polls in some ways, to instill some fear in Democrats and wake them up. But you also need people to be energized. And what we saw in that fascinating focus group you just did in Michigan is that people are a little scared. I'm thinking of the trans woman who was talking about the impact of a Republican being reelected, of Trump being reelected. But they're not energized. And this fear of people staying home is something I hear from Democrats over and over and over again, of young people staying home, of base voters staying home, of people not being energized. So, yes, the economy, they need to run it to a draw. That's what the Biden campaign needs to do. But they also need to get people energized around issues like abortion, around the threat of a Trump second term, around a range of things that's going to get people off of their couches and out to the polls.
And, Matt, what are you hearing inside Republican circles? Because some folks I speak to tell me, look, inflation's coming down. There's a real chance that by Election Day, that divide that the voters are talking about, where they don't feel that the economy is getting better, could start to turn a little bit of a corner.
It's certainly possible, but at least for right now, that chasm is so big, whether it's not just cost of living and inflation, it's the housing market. The lady talked about trying to buy a car. All of those markets are so illiquid, it's hard to actually finance those things. You see it every day. And so Republicans are going to press that advantage as much as possible, because in their mind, we've gone from, Bill Clinton's "I feel your pain" to Joe Biden's essentially telling you your pain isn't real. And I think with immigration, as we talked about there, look, coming off the trail with Tim Scott, that is such a huge issue, not just in border states, not just in border counties. Debbie Dingell talked about fentanyl. This touches so many different counties in America. By Biden taking a deal, if one is offered, that's a huge general election help for him. It really means a lot.
I agree with Matt. I mean, this is something that the base voters in the Democratic Party will hate and will be outraged by, and there will be a lot of people in the White House who will not love details of this. But in the general election electorate, there is a fear of chaos at the border, border security. It's a real issue. It doesn't mean it's entirely valid, but it's a perception challenge.
Court, let's talk about this potential deal, because Ukraine is a big piece of it. I talked to Senator Lindsey Graham about it. President Zelensky was here trying to make the case. I mean, how desperately do they need this aid? Give us the reality check and what came from that visit.
They need it. I mean, in a word, they cannot win the war without this continued aid. There have been some small tactical gains, even just this week, actually. We saw that the Ukrainians were able to push into an area in the east of the Dnipro River. That'll give them the ability to bring supplies, equipment across the river throughout the winter. Small, hard-fought, costly tactical gains, but it will take many of those before we really see any kind of a breakthrough here. And the reality is, the U.S. has been giving them $44 billion in aid and equipment since the invasion, and we're still seeing a war of inches at this point. And it's been a very difficult realization, but we're even starting to see some wavering support among senior military officials. Publicly, absolutely not. They are still all in for Ukraine, absolutely. Privately, they are starting to talk about the fact that this is a stalemated war, and even with this extensive amount of support that the U.S. has been giving them, they still are not seeing any major breakthroughs.
Such a significant revelation. Jeff Bennett, there is also, of course, this impeachment inquiry that has been opened up. Could President Biden use this moment to try to galvanize his base around him? And could it backfire against Republicans? What are the politics of this?
He certainly could. I mean, the risk for Republicans is this. Never before in the history of this country has a presidential impeachment inquiry moved forward in the absence of credible evidence. And that is what House Republicans are doing. Typically, House committees do the investigative work on the front end. They find evidence of wrongdoing, and they move on from there. That's not what has happened here. And so the risk for Republicans is that come come election day, they are seen focusing on the wrong things, not focusing so much on the economy or immigration, but on what could potentially be a meritless impeachment. The risk for the White House is that it becomes a distraction.
Jen Psaki, you had this surprise press conference by Hunter Biden this week. Did it help or did it hurt?
Look, I think if you're sitting in the White House right now, you're like, please, Hunter Biden, we know your dad loves you. Please stop talking in public. This is not helpful to any of them for him to be out there. But at the same time, the president loves his son. That takes precedent over anything else. That is appealing. I'm thinking of the woman in your focus group who talked about family. He loves his son. He loves his family. He's worried about his mental health. But yes, the White House would like him to probably go away right now.
Matt Gorman, could this backfire if Republicans don't find the smoking gun? Lindsey Graham said there isn't one yet.
I think that Republicans need to continue to take their time on this. And I think they need to continue to emphasize that this is not articles of impeachment. This is merely an inquiry. The biggest difference between now and 98 with Henry Hyde, to your point, Joe Biden isn't elevating this. He's not using this to rally Democrats around him. That's a very different thing between then and now.
Not yet.
We'll see.
Court, the world is watching. Here we are, 2 foreign wars. How do allies and enemies to the United States watch the divisions play out here?
And the U.S. has been increasingly more isolated on the world stage in the wake of what's been happening in Israel. October 7th, the entire world rallied behind Israel. But as we've seen this continuing humanitarian suffering, lack of food and water in Gaza, continuing strikes and ground offensive by the Israelis. I mean, even this week, we heard about 3 hostages who were killed by IDF soldiers. Israelis are going to investigate that, of course, but that is putting growing and mounting pressure on the U.S. to really call out Israel. And we saw that this week with Jake Sullivan's visit, and we'll see more of it with Secretary Austin.
We sure will. Thank you all. Happy holidays. Great conversation. That is all for today. Thank you for watching. We will be back next week because if it's Sunday, it's Meet the Press.
Invest with an advantage with CNBC Pro. Exclusive access to investing experts and analysts, customized tools, wealth management, and investment strategy. Plus, actionable analysis of global market coverage and the biggest names in business and investing. Become a smarter investor. Become a CNBC Pro with an exclusive offer for a limited time only. Go to cnbc.com/pro offer now.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
My parents were Holocaust survivors. They taught me that nothing is impossible. When we set a goal for ourselves to bring a vaccine to the world against COVID, we knew that failure is not an option. Ambition is an integral part of every big success. If we are working for the bottom line, we will never achieve it. What you need to do is to work for the purpose of your company. In Pfizer, I think we have learned when you give to people ambitious goals, you will be surprised how much they can deliver.
So Wall Street delivering its 7th straight winning week on bets. The Fed is finally pivoting and is going to start cutting rates earlier than expected next year. The dollar slipping as investors ditch the higher for longer notion. The move reversing the yen's decline, sending Japan Inc., corporate Japan, scrambling just ahead of the Bank of Japan's decision tomorrow. Plus, oil settling a little bit lower Friday, but up slightly for the week, though, thanks to a weaker dollar. But worries about slowing growth still dominating sentiment in the oil pits. All right, so just a little less than 2 weeks ago before we wrap up 2023, and it has been a wild ride so far this December. The Dow and the NASDAQ hitting record highs on Friday after a pretty choppy session. All three major averages have gained 7 weeks in a row now, as we headlined, as Treasury yields have pulled back, and we've had, conversely, an epic rally in bonds. Let's take a look at the pricing now in terms of yields. The benchmark 10 is at 391.48. 2 is most sensitive to what the Fed does or does not do. 444.90 right now. So the 10 is down pretty sharply from around about 5%, remember, just about 2 months ago. Investors are betting the Fed is finally pivoting and will start easing monetary policy earlier than expected next year. Traders, in fact, are now pricing in more than a 60% chance of a rate cut, a first one to happen as soon or as early as March of next year. Here's the but, though, and there's always a but, right? The New York Fed's John Williams downplaying that pivot talk in an exclusive CNBC interview. That was after the Fed decision last week. Here is some of what he had to say. Take a look.
We aren't really talking about rate cuts right now. We're very focused on the question in front of us, which, as Chair Powell said, the question is, have we gotten monetary policy to a sufficiently restrictive stance in order to ensure that inflation comes back down to 2%? That's the question in front of us. That's what we've been really thinking about for the past 5 months, and I think we'll be continuing to think about for some time. So that's the topic of discussion for the committee. That's the decision we made to hold the Fed funds target where it is. Now, clearly, we all put in projections for interest rates and inflation and growth and unemployment as well. Those are individuals thinking about what may happen over the next 3 years on a baseline path. But the discussion really at the FOMC right now is about, do we have monetary policy today in the right place, and not speculating on what will happen at some point in the future.
So the New York Fed's John Williams, they're pushing back on this early pivot thinking there. All right, so let's take it back to markets in this part of the world and see how we're starting up the Monday session. You've got New Zealand down about 1/5% and more, off to a weak-ish start. Their dollar, the Kiwi, at 61.98. Sydney next online, less than 60 minutes to kick off there. SPY futures handicapping what looks to be a down start. Australian dollar, AUD 66.96. And Tokyo's online in less than 2 hours' time. Futures there calling for what looks to be a softer start as well. Dollar yen 142.09. We'll take a quick break on Squawk. We're back in 2.
Our world is moving faster than ever before. There's an opportunity to build a better financial system for our future, advancing economic progress for all by modernizing markets, unlocking access to capital, and fighting financial crime. Because we believe today is another step forward in our relentless pursuit of a better world, accelerating your journey to rewrite tomorrow.
I think a lot of things have changed since 2 years ago, and more travels to inland Spain, to our natural parks, to open spaces, outdoors activities. That is a trend that we have noticed, with more concern on sustainability matters.
Indonesia have moved from the sun, sea, and sand to serenity, spirituality, and sustainability. You're moving away from mass tourism quantity, but you're moving into something that would really generate longevity. And it's not technological per se, but more value innovations that all these tourist destinations needs to upgrade themselves.
podcast that explores the biggest tech news from across the globe, is back for a new series. Listen to CNBC's Beyond the Valley every Wednesday as we bring you insight into the top stories, unpack the latest trends, and find out where the industry is headed.
Welcome back. Monday here on Squawk Asia. So, of course, it's the holiday season right now. And as we close in on Christmas, it's just 7 shopping days away. We take a closer look at how some of the hottest items get from the factory floor to a retailer near you. CNBC's Eunice Yoon, Jane Wells, Pippa Stevens, and Courtney Reagan all take us on a cross-Pacific and cross-country journey of the iconic Care Bear. And it all starts at a manufacturing site in, when you know it, China. Take a look.
While the U.S. fights inflation, China struggles with deflation, and that's translating to lower pricing at the factories. During the global supply chain disruptions 2 years ago, the cost of making a Care Bear was up 25%. Today, it's back to where it was before the pandemic. Slower growth here has reined in material prices as well as workers' wages. And with U.S. orders harder to come by, factories compete with cut prices. Logistics costs are also in check. No more tight COVID controls, and shipping containers are plentiful at the Chinese ports. So products that had been held up for months on the factory floor in 2021 are now shipped out to America almost immediately.
Nowhere is the difference in the supply chain more visible than here at the ports of L.A. and Long Beach. When I was here 2 years ago, there were 65 ships anchored offshore waiting 10 days for an appointment. Now, I don't see anything, and ships are going right in. The UN says global trade is down 5%, and shipping container costs are down almost 90%.
50% of the truck gates go unused every day, and that means we have capacity.
In November, container volume was up 19%, but overall for the year it's still down. That's partly because labor tensions sent some ships away from the West Coast.
It's a similar story with trucks and trains. 2 years ago, there weren't enough as consumers loaded up. But today, there's too much supply and not enough demand. Volumes are down and spot rates have dropped 40% since 2021. With all this available freight, it's now cheaper to ship this Care Bear from the port to the warehouse and on to the final destination. But whether or not all these savings are passed along to consumers can depend on the retailer.
The journey for this Care Bear from a factory in China to a toy store like this Toys R Us on the East Coast is back to normal, now taking about a month. 2 years ago, it was twice as long, and transportation costs were making up almost a quarter of the bear's total cost. It's now down to 5%.
We're just seeing less pressure on the manufacturing cost and the transportation cost, a little bit more pressure on other areas of the supply chain, and also our customers are looking for more value. So we're being squeezed a little bit.
Toy maker Basic Fun was adding a transportation fee to retail invoices 2 years ago. Now those are gone. If you look at toy deflation, seasonal discounting, and consumers' desire for lower priced toys, you're going to find this bear retails for about $15 in most stores. That's down from $17 to $20 2 years ago.
All right, go and get your Care Bear now. So this year, 2023, may be winding down, but there is still a raft of data and also events on the calendar that could move markets this week. Among other things, we'll get revised U.S. GDP data dropping on Thursday. The highlight, really, though, is the personal consumption expenditures, or PCE, data that's set to drop on Friday, which is, of course, the Fed's favored gauge for inflation and could affect policy direction. Now, out here in Asia, investors are waiting for the Bank of Japan's decision. No change is expected, but Governor Kazuo Ueda could offer more clues on when the bank's policy pivot could take place. Ahead of that, we've got dollar yen at 142.09. We'll take another quick break on Squawk. We are right back after this.
world's first city, built for play, is coming to Saudi Arabia. Don't just live life. Play life. Qiddiya.
Japan is often thought in two different ways. As a country, has a great respect for nature, and as a great metropolis with world-beating technology innovation. Solar energy has become the most productive, renewable energy source in Japan. With a sympathetic approach to local communities and nature, we can keep city alive and preserve our natural scenery.
He's doing away with Keppel's conglomerate structure and transforming the company to become a global asset manager.
It's a change in the business model where we are going more for recurring income.
On its green energy investments.
We want to be there, we want to know what's happening, but you don't want to be too early as well.
Catch my interview with Loh Chin Hua of Keppel on the next Managing Asia.
Welcome back Monday here on Squawk Asia. U.S. lawmakers have yet to reach a deal on a $110 billion package, which includes providing aid for Ukraine and other national security interests. Now, Congress is also racing to come to a compromise on the country's border security funding and rules. But further talks are on hold as lawmakers are scheduled to go on holiday for the rest of the year. Now, South Carolina Republican Senator Lindsey Graham talked to NBC's Kristen Welker on the back of this. Here is a slice of their conversation. Take a listen.
The only way we're ever going to secure borders, we got to make them do things they don't want to do, but they're getting there. It was a choice by the Biden administration to change policy. It led to this debacle. But there is progress on asylum. There's a ways to go on parole. You tell me Ukraine's important, I agree with you. To all the national security experts, when you say if we don't help Ukraine, they could lose and the world would fall into chaos, Putin will keep going, I agree with you. But if you're a national security expert, you should have the same energy and vigor to fix a broken border.
Senator, this week you said, quote, I'm more worried about our border than Ukraine, 100%. If you don't get a deal on the border, are you willing to walk away from aid to Ukraine, or is that not still essential?
I am willing to help Ukraine. The package sent over by the president was pretty robust. The package sent over by the president to help Israel, I'm 100% for. The package sent over in September to help Taiwan, count me in. The border provisions sent over in September are a joke. October the 7th is a game changer. The FBI director said he's never seen more threats to the homeland than he does now. We're helping Israel, and jihadist groups want to hit us to punish us for helping Israel. I will not help Ukraine, Taiwan, or Israel until we secure a border that's been obliterated. You see from Mr. Castro, Congressman Castro, the attitude here. Anybody who wants to secure the border is a racist. That's BS.
Well, let me just get your sense on how critical Ukraine is, though. Do you still see getting aid to Ukraine as critical to U.S. national security?
Let me tell you what will happen if we pull the plug on Ukraine. Putin will keep going. We'll be in a war with NATO. China will see that as a green light to go into Taiwan. It would be a national security nightmare for Europe. If you don't help Israel destroy Hamas, if Hamas is still standing when this is over, God help us all. I get everything. Now, where are the same people lecturing me about Ukraine on our border? Our border is a national security nightmare. They chose bad policies. It's bit them in the ass, and we're not going to continue these stupid policies. We're going to change them.
All right, Lindsey Graham, not mincing words there, talking to our colleagues on Meet the Press. All right, bring it back to this side of the world. In China, non-banking payment companies are set to face tougher regulation. Over the weekend, the State Council published new rules to increase oversight of the space. The rules are aimed at licensing as well as protecting user information to help reduce risks and criminal activity in the sector. The regulations will affect major payment platforms like Alibaba's Alipay and also Tencent's WeChat Pay, and will come into force in May of next year. Down in Australia, the government there is just out with its adjusted outlook on commodity export earnings. This was earlier this morning, in fact. The country now expects earnings to hit 408 billion Australian dollars through the fiscal year ending June. That's a little bit better than earlier forecasts. and is because of stronger global growth and more steady demand from China, which is Australia's largest trading partner. But overall, the earnings are still set to fall significantly from last year, and the government expects even further declines in the next fiscal year. Right, we're still on Central Bank Watch. After the Fed, we've had the ECB and also the BOE. Now it is the turn of the Bank of Japan, the BOJ, which is set to hold its policy meeting and decide on rates this week, 18th and 19th. In fact, analysts polled by Reuters, the news agency, expect no change in the BOJ's final policy decision of the year. But 80% of analysts and economists polled by Reuters see the central bank ditching negative interest rates by the end of next year. Some even expect the BOJ to start unwinding its ultra-long monetary settings as early as next month, which is January. Now, the yen, of course, has strengthened, well, quite a bit after hitting a low of near 152 versus dollar back in mid-November. Right now, dollar yen pricing 142.10. We've had it below. We've had it in the high 141s over the last several days. As far as the other major pairs and crosses go, FX, Forex-wise, here's how they are shaping up. You've got dollar index, top left-hand corner of our beautiful wall, pricing 102.550. And this is post the New York Fed's John Williams comments, pushing back on an early Fed pivot. Again, dollar yen 142.10, euro against the dollar, European single common currency at 108.93. And for what it's worth, the Australian dollar at 66.97. So, dollar, having said that, has regained some of its losses after John Williams' comments downplayed the pivot talk in an exclusive CNBC interview. Here's a slice of that exclusive CNBC conversation. Take a listen.
It's still a highly uncertain situation, both in terms of inflation, in terms of the progress of the economy. So right now, I think the base case, at least I'll speak from my own view, the base case is looking, pretty good. Inflation is coming down. The economy remains strong. Unemployment is low. And so when you think about have we gotten policy to the kind of appropriate place, it's looking like we are at or near that in terms of sufficiently restrictive, but things can change. One thing we've learned even over the past year is that the data can move in surprising ways. We need to be ready to move to tighten policy further if inflation, the progress in inflation were to stall or reverse. And the committee is clearly focused on making sure that we bring inflation back down to 2% on a sustained basis. Now, we need to be data dependent and respond to and take the right policy decisions depending on what transpires.
So the market sure thought you were talking about rate cuts and projecting rate cuts. What do you make of how the market reacted, both in a huge downdraft in bond yields and an updraft in stock prices?
Well, the market, one thing that's been really interesting over the past year, we track this obviously very closely here at the New York Fed, is the market reactions to all kinds of news or economic data, all types of events, and has been much bigger in magnitude, much larger than is historically normal. I think that reflects in large part the uncertainty, the unusual nature of the situation we face. So, the fact that we're seeing big market reactions to pretty much everything has been a pattern that we've seen over the year. In terms of the, what we're seeing about the market saying, well, the FOMC is going to do this or this so many, rate cuts this year, I would just point people back to the economic projections that we put out. If you look at the median projection, over the next 3 years, the median shows that, basically, gradually over the next 3 years, the policy restraint that we put in place being dialed back gradually over 3 years. That's the view of the committee. I think that's consistent with our view of how the economy is going to evolve. I think the market, in a way, is kind of reacting very strongly, maybe more strongly than what we are showing in terms of our projections.
Do you believe the Federal Reserve can cut interest rates next year?
Well, again, we can do whatever is appropriate for achieving our goals. You look at the way I think about this is if we get the progress that I'm hoping to see on inflation, on the economy, then of course it will be kind of natural for us to move monetary policy over extended period of time, over a few years, back to more normal levels. That has to be in the context of us being confident that inflation is moving sustainably toward our 2% goal. That's absolutely essential to see that. But under those conditions, which is my baseline forecast, of course we need to move policy back to normal levels over a period of time. We got to be data dependent and able to adjust according to what we're seeing.
John Williams there, the head of the New York Fed, talking to CNBC's Steve Leisman there. So keep talking and bring in Thierry Weissman, Global FX and Interest Rate Strategist at Macquarie Group. He joins us now live. Thierry, great to see and appreciate your time. Thanks for staying back to do this with us. So, you know what? If it were anybody else other than John Williams, I wouldn't be thinking what I'm thinking. But, you know, we've had Powell dovish. We've had a bunch of other Fed officials dovish as well. And then Williams comes out and says what he says, pushing back against this idea of an early Fed pivot and early interest rate cuts. You know, given the importance of the New York Fed, by assets the biggest, right, the most active as well, and Williams is basically considered the first among equals of the Fed governors. I mean, what he says has a lot of weight. What do you think?
I agree. I think the paradox here, if you will, is that there was a board member, Chris Waller, who came out before the FOMC decision and meeting and had hinted at the prospect that rates would be cut in 2024. And now he's a hawk, Chris Waller. And the market took that to be very significant because until now, he had been unwilling to concede the prospect that there would be monetary policy normalization by way of easing. And now you have someone who's a little bit more middle of the road. Some people have described John Williams as a bit of a dove, and he's pushing back on Jay Powell's view, which was very, I think, very clearly conveyed in the press conference post the FOMC, pushing back against the view that the market should expect these rate cuts to be early. So the paradox here, of course, is that you have a hawk about 2 weeks ago arguing in favor, presumably, of rate cuts, and now a centrist or maybe a slightly dovish Fed official saying not so soon, not so fast. What is happening here? I think what is happening here is that this is a question of timing. I think that the FOMC and the broader cadre of Fed policy officials now agree that the way things are heading, especially with regard to inflation, rates should be cut next year. That's what's appropriate. It's appropriate also with respect to the dots. I think there were only 2 Fed officials who did not want a Fed cut next year, and that's clearly a minority. But where the division is, I think, is with respect to the timing. And if you think about it that way, you'll see that there really isn't that much daylight between the hawk, Chris Waller, and the centrist Jay Powell and the centrist John Williams. I think it's about timing. I think that the FOMC is trying, and the Fed officials more broadly, are trying to tell the market, yes, rates will be cut, but don't necessarily expect them to be cut as early as March. I think that is the signal that the market should take away from the collective of communications that has come out in the last few weeks.
All right, not as early as March. It's the first cycle of cuts is not going to get underway that soon. Where are you, Thierry? I'm curious. Are we talking June or later?
Well, I have to agree with all of them because in some sense what I just said is that they're not necessarily in contradiction with one another. If you consider that what they're trying to say is that we may only have disagreements about the timing. I believe that rates will be cut towards the middle of the year. I don't believe it'll be in the first quarter the way that the fixed income market and the OIS market in particular has priced rates, that is, with a cut in March. Now, think about it this way. Before the Fed starts to cut, at the very least, they have to get away from their tightening bias. Once they get away from their tightening bias, they presumably go to a neutral bias. And then from the neutral bias, they have to go to an easing bias. And then they've presumably adequately prepared the market for a cut. Well, that's 3 steps away, right? And that, because of that, it seems as if March is too soon. And it seems that if you have to take those 3 steps and you have to wait at least one meeting between all of those steps, it looks like it possibly might be the second quarter, not the first quarter.
All right. Thierry, listen, hold that thought. We're going to come back and talk a lot more in just a little bit. We'll continue with Thierry Weissman there in just a little bit. Meantime, we'll take a quick break on Squawk. We are right back in 2.
Peaceful. It's like a break from the reality, and then you can go to like the extreme opposite.
Whatever you love, you will find it here.
The whole thing is just mind-blowing.
CNBC looks at ways of making your money work for you. We'll explore how to use your wealth to further life's most important goals. Is it just as simple as putting money away?
Now inflation is falling, you can earn higher than inflation on cash.
How can investors protect themselves against the cost of living crisis?
Equities is the best instrument to use to beat long-term inflation.
Activating Wealth on CNBC.
Activating Wealth, sponsored by Standard Chartered.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech. On CNBC.
For as long as I can remember, I have always considered myself pretty ambitious. I always wanted to be a television journalist. When I started out covering foreign exchange, I actually taught myself how to trade currencies because I wanted to understand what people wanted to know. My grandfather, who was a Holocaust survivor, inspires me every single day. And growing up, he always used to have CNBC on in the background. Every day is fun covering business news. Every day is different. It is never boring.
CNBC. Live ambitiously.
Monday on Squawk. Welcome back. We are back with Thierry Weissman. The Macquarie Group still with us live. Terry, we'd love to stop talking about the timing, and you're with the consensus. You think first cycle cuts are going to start around about halftime next year. Let's get to the next question, which is also important, maybe more so, and that is this first cycle. And we haven't seen one in quite a while, right? What are we talking about? Are we talking 125, 200 basis points? I mean, what's going to be needed, do you think?
Oh, I think in view of how sharply inflation may continue to come down in 2024, and in view of the prospect that we may get a consumer slowdown in the U.S. that takes us to a point where some of the quarters between now and the end of next year are zero quarters for growth, it's altogether possible that when the Fed starts to cut in the middle of the year, they may cut fairly aggressively. It could be about 200 basis points.
Ooh. Is that priced into dollar right now?
No, I don't think so. I think what the market is pricing in right now is some sort of soft landing scenario with a modest to moderate decline in inflation. We take a more optimistic view on inflation, if you will. We think that it could get well into a two handle. In fact, it could get there by the middle of next year if rents in the U.S. continue to come down as quickly as they have in the new tenant market, in the new lease market. So that could happen. Also, I think the market is a little bit more optimistic with regard to the strength of the consumer. I think here the consumer is really tapped out in the U.S. Savings rates have been low. People need to save for retirement. They are not getting the kind of access to credit that they did earlier this year. I think all spells for a slowdown in the consumer. And of course, as you know, that is 2/3 of the economy. If the consumer slows, it's going to be the case that the broader economy slows too, even though there might be offsets from investment. Residential construction potentially could stay stable. There are offsets, of course, but if the consumer slows, it will mean a slowing in GDP growth.
All right, so 200 basis points in the new cycle that's set to begin sometime next year, probably mid-year, halftime. That would take dollar yen down to what, Terry?
Well, conceivably by the end of the year, it could be well into a 120 handle. 125, 130 is not inconceivable in view of the prospect that the Fed will be cutting aggressively, and also that the dollar yen are misaligned right now. The dollar is just way too expensive relative to the yen and has a lot of room to come down. It could happen on the back of a change of BOJ policy, but the real driver here will be an overall thrust of a weaker dollar coming off the back of the Fed's rate cuts.
All right, let's talk about the other side of the trade now and bring the BOJ in. These guys are huddling starting today, in fact, should have a decision and commentary tomorrow from Ueda-san. So if you're looking at 120, not inconceivable by the end of this year, that's a pretty sharp move from where we are now, 140-ish, just over that. And for the Japanese, Japanese corporates especially, that kind of moves so fast. They're going to be screaming. Do you think that's going to hold the BOJ back from doing, honestly speaking, what they've needed to do for quite a while now, which is exit?
No, I don't think so, in part because what they have now in negative interest rate policy is really at variance with where other central banks are, even if those central banks start to cut in 2024 the way the Fed would, the ECB would, the BOE would. So I think there is such a gulf between the policy disposition of the BOJ and the other central banks that convergence calls for the BOJ tightening somewhat and the other central banks easing somewhat in 2024. The combination of those two forces is what's going to cause dollar yen to fall. But I want to stress here, this is not about the BOJ. This is much more about broader dollar weakness that we see. And to the extent that the dollar yen comes down the most, it's only because it's the most distorted of the pairs in the developed market FX.
I hear you. Misaligned as you described it. Yeah. Describe first. What's it going to look like when the BOJ finally starts to move? They've already come out and said not so long ago that, look, this whole idea of unlimited buying of Japanese government bonds, JGBs, we're not going to do that anymore. That should have been a pretty strong sign for everybody. What is the next step, do you think?
Well, the next step conceivably is to get rid of the negative interest rate policy, the so-called NIRP, and move it to a ZIRP, a zero interest rate policy. It's hard to fathom why, after Japan is actually starting to see some growth, some traction in its recovery, that they would maintain a zero interest rate policy. I take seriously the signs that came out of the BOJ a few days ago pertaining to the end of the negative interest rate policy. I just don't think it's going to be in December. But I think what they were doing is setting us up for the prospect that we might move to a zero interest rate policy in the first quarter of next year, if not the second quarter, coincident when the Fed starts to ease. And from there, of course, if there is wage growth in Japan, to some extent, they would continue to move towards tighter monetary policy. What's interesting is wage growth matters in Japan, but it also matters at this point in the U.S., in Europe, in the U.K. We have moved away from thinking about CPI being the important thing that central banks watch, as being wages, which have been very different in terms of their trajectory. In the U.S. and in Japan, of course, in the U.S. you're seeing lower wage growth now. In Japan, you've seen low wage growth throughout. Of course, in the UK and Europe, you're seeing very high wage growth. So that's what's setting the pace for these central banks at this point. In the case of the ECB and the BOE, of course, they're staying a little bit tighter than they otherwise would because wages are high. In the case of the BOJ, they have until now stayed a little bit more easy, in part because they're waiting for wages to pick up.
Yeah, I think in Japan's case, it's more a case of sustainable wage growth, right? So we'll be watching to see what happens with their unions in the next round of talks. I think that's coming up in March or so. And in terms of, I think after this current meeting, their next at-bat is probably in January, so we'll be watching out there. Tactically, Thierry, I'm curious, once this starts happening, right, it's like what's been really fantastic for so long, this yen carry, that goes out the window. What's next? What is the next carry, do you think?
Well, it doesn't have to be a situation where you fund in yen, obviously. You can fund in other currencies as well. What's interesting about the world right now is that there is a huge divergence in nominal interest rates and nominal policy interest rates around the world. Even if we put aside for a moment the fact that the BOJ has negative interest rates, and I'm talking about now the high side of the range of interest rates, not the low side. You'll find in some emerging markets, of course, that interest rates are still above 11% or 12% in some of these markets. So to the extent that you can find an emerging market with 11% nominal policy rate where inflation is set to come down, and there's a possibility that those rates will come down. If you can take a little bit of duration there, maybe in the 6-month or 12-month tenors, that's where your carry will be. And whether you fund it in yen or in dollars or in euro won't make that much of a difference. Where you're looking to make the money is on the positive side of the carry, not on what you pay. And you can find that large positive carry in the emerging markets these days.
Get specific if you could, Thierry. I mean, this whole interest rate cut cycle thing, we've in EM, emerging markets, we've already seen them starting up in LATAM. Who's next? And talk currencies. I mean, who do you like?
Well, I mean, if you really want to be combining the view on monetary policy with the structural view on the economy, and since you mentioned Latin America, I'll stick there for a moment. Chile is a very interesting story, in part because they benefit from lower oil prices, which is what we're seeing now. They benefit from the energy transition because they export copper, which is critical to the upgrade of electric grids, and by way of that, the energy transition. At the same time, they have very high nominal interest rates still. So that's an interesting story. And of course, they, about a year and a half ago, people were worried about the policies coming out of the left-wing government there. Now people are a lot less concerned about that. The political winds have shifted in Chile. So it seems like it's a coalescing of a bunch of good things, at least from the perspective of a market investor. Mexico could be a good story, too. It doesn't have to be a bad story, even though there's an election next year that might pose some problems for investors who prefer to see, let's say, some political stability. There is still a reshoring story, for example. The central bank is conservative by keeping interest rates high. That could be conceivably another place to look for carry in Latin America.
Terry, real quickly before we let you go, let's talk about the 800-pound gorilla in the EM space, and that is China. Do you have a view on dollar China, and tie that into some of the stats that we've been looking at recently? They're losing appetite for U.S. bonds, for U.S. treasuries, aren't they?
Yes, that's true. But I wouldn't necessarily say that this is going to cause the dollar to collapse. because just at the same time that the Chinese may be losing some appetite for U.S. Treasuries, there's some other entities out there, including in the private sector, that have been stepping up their purchases of U.S. Treasuries. So this is I think a call that's way too early to make. That is whether the U.S. dollar will lose its reserve currency status because of what the Chinese or the Russians are doing. I can tell you that the general direction for dollar renminbi next year is also downward, but this is again predicated on the view that we are going to have a general dollar weakness next year, and the PBOC will manage to that dollar weakness by allowing the fix to maybe start to come down ever so gradually throughout 2024. What is the risk to that story? Well, I think it's the risk that you and I would both acknowledge at this point. It's what if China never really gets out of its growth funk? And as a result, they really don't care what the dollar is doing. They need to drive competitiveness through a weaker yuan, in which case we would be wrong. And we don't see dollar yuan come back down in 2024, even marginally. I think this has as much to do with the political backdrop in China and whether President Xi wishes to unleash the power of the private sector to drive growth, or whether he's going to continue to alienate a lot of people in the private sector who would otherwise like China, despite the property market problems in China. A lot of this turns on the politics of China. And it's not just a problem you see with regard to the management of the currency and where the currency is going to go in 2024. It's clearly a problem that we see with the stock market as well. And given the very low multiples that it will be trading at right now, to induce money to come into China, it's not just a question of promoting growth, and it's not just a question of saving the property sector and promoting aggregate demand by supporting credit to the households. It's really also about supporting the tech economy, the nascent tech economy, the growth economy in China. And for that to happen, it has to be a political decision to move away from the policies of the last 2.5 years or so.
Yeah, I would agree with you. And I think layer on top of that, I think it's also an issue of trust and safety with regards to foreign money. Terry, listen, we got to go. Great to talk to you. Appreciate the time. Happy holidays and keep safe. We'll do it again very soon, I hope. Terry Weitzman there from Macquarie Group joining us live. Merry Christmas. Pleasure. All right, bring it back to this side of the world. We were just talking about this. In fact, Japanese Prime Minister Fumio Kishida is facing a major backlash over the recent fundraising scandal that led to a huge cabinet reshuffle. Just last week, a GG press poll showed that his approval ratings fell to an all-time low of 17%. The latest Nikkei TV Tokyo poll also looking pretty dismal, putting approval ratings for Kishida's cabinet at 26%. Now, disapproval for the administration also jumped for the fourth month in a row, up to 68%. Respondents blaming Kishida for the financial scandal and expressing dissatisfaction over the way that he's handled inflation as well. Support for the Liberal Democratic Party, the LDP, has also taken a tumble following the recent events. All right, time for another quick break. Squawk is right back after this.
So this vehicle, Project X, is a 3-seater vehicle. It is specifically designed for shared mobility. But also, we understand that because those service providers, they're ultimately having those vehicles to serve end consumers. So we're thinking about it from an end user perspective of how can this vehicle be more engaging. So think about the scenario where when you're maybe on your Uber, your car rental app, and you're trying to book for your vehicle, and then there's probably like 10 exact same looking car on the parking spot, right? How do you know which one is yours? And with this interface, right outside, right, once you book your car, it can actually display some kind of, hello, this is your vehicle, right? I mean, so we can start engaging with the end users right even before their journey starts.
Keep up with the crisis. Understand what's moving and why.
I need Carl to translate Kramer.
Squawk on the Street.
Real trades.
Economic growth is a lot better than people expected.
Real debate.
First of all, I don't think it's an argument. And second of all, we're going to have it.
Halftime report on CNBC.
Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
This FYI is sponsored by Interactive Brokers. Direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
Final full week of trade for some Asian markets for the year 2023, Hong Kong included on the economic calendar. Hong Kong unemployment due tomorrow. We have Hong Kong inflation reading, which comes through on Thursday, and Taiwan jobless figures out on Friday. The People's Bank of China is scheduled to publish the benchmark lending rates on Wednesday.
Minutes from the Bank of Korea's November meeting will be released this Tuesday. South Korea's November producer price index is crossing the tape on Thursday before the market open. And LG Chem is holding a groundbreaking ceremony for a $3.2 billion anode material factory in Tennessee this Tuesday.
Sentiment numbers come out Monday, the first of a slate of housing data that will be released ahead of the Christmas holiday, which includes existing and new home sales later in the week. The Nasdaq's annual reconstitution becomes effective before markets open on Monday. Plus, the founder and former CEO of electric and hydrogen-powered truck maker Nikola will be sentenced. The prosecutors are seeking an 11-year sentence for Trevor Milton, who was convicted on securities and wire fraud charges. And lastly, Jeff Bezos' Blue Origin space company opens its launch window for its next Shepard payload mission on Monday. It comes more than a year after its uncrewed, fiery failed launch in September 2022.
This FYI is sponsored by Interactive Brokers. Direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
At Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
We've been speaking to industry leaders and asking for their thoughts on the outlook for the green transition.
The problem that Europe has today about security is also that it is not controlling the supply chains.
Renewable energy in our continent is a very positive step in the right direction.
If we are not going to do anything, nothing will happen. If we try to do something, we give the planet a chance. We have to try, but we have to try harder.
Why is it important for you to be here?
The fact that the fashion industry doesn't really have any, there's not really any kind of goals being set for my industry.
When you start to electrifying heavy machinery on construction site, it also means less pollution, air pollution, less noise. And of course, that is something that's really appreciated in urban areas.
Whatever we do here, if it is consistent and features enough and it is clear, will boost thousands of millions being invested in this transformation.
It's a Monday morning. Welcome back. This is Squawk Asia. Take a look at oil now. Prices finished slightly lower on Friday on the back of a seesaw session. Brent finishing at $76.55 from a NYMEX at $71.43. So there's the price action. The International Energy Agency, the IEA, out with a forecast for global oil consumption to rise by 1.1 million barrels a day next year, 2024. Meantime, Russia's Deputy Prime Minister Alexander Novak said the country is eyeing further oil export cuts of about 50,000 barrels a day this month as part of an OPEC Plus deal. Spring and Eric Nuttall, partner and also senior portfolio manager at 9 Point Partners. He joins us now live out of Toronto. Eric, good to see you and appreciate your time. Thanks for staying up to do this with us. So oil's at about 76.5 or so. Brent, that is. Where is it going from here?
Yeah, so when we look at the oil market today, it's staggering to see that sentiment is lowest in history as far back as our records go. We've had a massive liquidation in net speculative length, and we use that as our proxy for optimism or pessimism. And so the market today is more pessimistic than it was during the depths of COVID when we had the biggest demand shock in history. So we've seen a 20% plunge in oil over the past month and a half. I really think what is driving that is a false narrative. And that false narrative is that demand is weak, that U.S. shale is surging, that cohesion within OPEC is faltering, and that they're about to flood the market and teach the shale companies a lesson that they didn't learn from prior busts. We really think that the sell-off in oil cannot be explained using fundamentals. Yes, things have softened a little, U.S. production beating expectations slightly, demand weakening a little. But in aggregate, when we look at inventories still at their lowest level since 2017, and that again as far back as satellite imagery goes, we think fair price is closer to $85 Brent, not 76 where we trade right now.
Wow, so about more than $10 below where you think fair value is. So this record pessimism you talk about, Eric, I mean, this is kind of hard to digest, right? How much of it is also the thinking that the buyer of last resort, which is China, right, the second biggest economy in the world by some estimates, right? They're settling in this new normal economic funk of 4, maybe even below 4% growth.
Yeah, so we have seen strong demand from China, very little signs of faltering demand there. SPR buying has ebbed and flowed throughout the year. But you referenced the IEA's forecast next year of demand growth of about 1.1. To us, that sounds very reasonable. The biggest surprise this year has not really been on the demand side. It's been on supply. And this storyline that, shale producers haven't learned from the sins of the past. They're now chasing rampant production growth, and therefore you're going to have more barrels coming from OPEC next year. We think that when you look at where has the growth come from in the United States, the vast majority of it has actually been private companies. And the reason why that matters is that we've had a record amount of transactions this year of private companies selling themselves. There's been about $100 billion in the Permian Basin alone, public and private. And so private companies, right before they sell themselves, they jam up production. And so those assets are now held in the hands of public companies that are still governed by the need to increase dividends, do share buybacks, and while pursuing growth, much more moderate pace than the private. So we remain pretty optimistic that when you look at 2024, the biggest negative surprise has been U.S. shale, and we think that growth rate is going to have next year over this year.
So sticking to the production side of it, of things, Eric, I'm wondering whether or not one of the other reasons why oil is so underpriced right now is there is a lack of what folks call a geopolitical premium, right? And that surprised a lot of people on the back of October 7th, et cetera. It popped up, but then, things sort of calmed down and then went on the slide. To me, some of this doesn't make sense. I mean, I understand the narrative that, look, as long as it stays contained, Iran doesn't get involved, we're all fine. But that's a big if.
That was one of the best signals of how just deplorable sentiment is in the oil market now. We literally had oil tankers being struck by cruise missiles launched from the Houthis off the coast of Yemen, and oil actually opened down on that news. For those of us who have been doing this long enough, this is staggering. It feels like it's uncharted territories in terms of just how terrible sentiment is. We're in year end, liquidity is drying up, nobody's deploying risk. So, for the next couple of weeks, it will be what it will be. But I think when the humans at least come back to work, we think most of the trading has been done by CTAs, commodity trading advisors. They're now about 3/4 of daily volume. And it sounds like an excuse making, but when you see the collapse in oil price, when on a seasonal adjusted basis, we've never consumed more oil than we have in history. When we have to admit that shale is beaten by a couple 100,000 barrels per day, but in a 102 million barrel per day market, that's a rounding error. The market's absorbed Iranian surge in exports that are up 800,000 barrels per day since Joe Biden was inaugurated. Obviously they're not enforcing sanctions of any kind, not wanting to get the oil price up. But when we look at supply and demand expressed in inventories at their lowest level since 2017, it's very difficult to explain, a 20% price collapse in such a short amount of time. So it's not only been the quantum of the sell-off, but the velocity of the sell-off that reinforces our belief that those who are selling are computers. They're not human beings doing, counting barrels.
All right, we'll see what happens come Jan the 2nd, after everybody sort of shakes off their hangover. Here's another question for you, and it's in terms of correlations, Eric. We've been talking a lot about the Fed on the verge of pivoting, maybe an early pivot, etc. The first cycle of cuts around the corner. Some think as early as March, although there's been pushback on that. When and if that does happen, and we're seeing that reflected in pricing with regards to gold as well. That whole inverse correlation is back, right? The prospect of dollar going softer is sending gold up above 2,000. With oil, it's a lot more straightforward, right? Everything is priced in oil. You get a weaker dollar, should be much more competitively priced oil as well. Is weaker dollar priced into Brent, for that matter, problem dynamics right now?
Not at all. We think, again, the price of oil is undervalued by at least $10, given where supply, demand, and inventories are today. You would think, we've been battling this fear of a recession, at least in the United States and Europe, and fear-mongering that this is going to lead to a collapse in demand. We've been very public in our views that we thought that was, again, just fear-mongering. There's no basis in historic reality to be able to justify those concerns. But now that you've had an ultra-hawkish pivot by Powell last week, signaling, the end of rate increases and at some point the beginning of cuts, you're exactly right. A falling U.S. dollar means purchasing power of every oil consumer else in the world goes up very, very significantly. And that should help offset any demand weakness that we are seeing in certain areas like Europe. Germany specifically looks quite weak to us. So oil should be a beneficiary soon, again, when people come back to work in a few weeks' time.
All right, Eric, I hate to push you here, but we've established that oil is probably underpriced by about $10, right? Should be 85 rather than 75, 76, where it is right now. Call oil by, say, the end of the next year. What sorts of levels are we going to be looking at?
This is a boring reply, but I do think we are range bound. OPEC is being involved in the market a little more aggressively and longer than we thought necessary. We think their intent is to draw down inventories to offset the impact from the release from the strategic political reserve from Biden occurring over last year. If the market had to absorb almost 300 million barrels. So we think there is an upper ceiling of about 90 Brent until spare capacity becomes more normalized.
90. Okay, we'll pencil that in. Eric, great to talk to you. Happy holidays. Keep safe, keep warm. We'll do it again very soon. Eric Nuttall there from 9 Point Partners joining us live. We're back.
Our world is moving faster than ever before. There's an opportunity to build a better financial system for our future, advancing economic progress for all by modernizing markets, unlocking access to capital, and fighting financial crime. Because we believe today is another step forward in our relentless pursuit of a better world, accelerating your journey to rewrite tomorrow.
Paris, the city of lights, of love, and of luxury. But only CNBC reveals the city as only the super rich get to experience it. From luxury suites,
from just pushing this little button, here's your walk-in closet. It's a little bit of a secret room.
To a historic chateau with mind-blowing tech.
Right under my feet is the swimming pool.
And private yachts, famous museums, and shopping.
This is one of the most luxurious department stores in Paris.
Only on the next First Class.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
My earliest ambition was to be a teacher, but I felt I couldn't afford it. My mother thought it was the highest calling, and I gave her a promise that one day I would be a teacher if I did well enough in life. It was my ambition, and I was able to achieve it. So now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Good morning. morning, everybody. It is a Monday. This is Squawk Asia, 7 o'clock in Hong Kong and Singapore, 8 up in Tokyo. I'm Martin Sung here at the SGX. These are your headlines at this hour. Working with another decent lead from Wall Street Friday, U.S. stocks delivering a 7th straight week of wins on bets the Fed is finally pivoting and will start to cut rates earlier than expected next year. Dollar is slipping as investors ditch the higher for longer notion, the move reversing the yen's decline, sending Japan Inc., that is corporate Japan, scrambling just ahead of the Bank of Japan's decision, which is set to drop tomorrow. Plus, more saber rattling from North Korea, the country firing a short-range ballistic missile Sunday while blaming the U.S. for raising tensions on the Korean peninsula. Go figure. All right, so we know we're working with a fairly decent lead from Wall Street Friday, but we've got futures up and running as rolling as well in the early goings of Monday out here in Asia. Here's how they're pricing. Handicapping looks to be maybe a patchier start when Wall Street gets back up and running tonight, Asia time. But in the here and now, though, Sydney just coming online for the Monday session, opening up weak-ish. Just below the line on the S&P SX 200, their dollar, the Aussie AUD at 66.99. Tokyo opening up for trade, fresh week of trade in less than 60 minutes time. CME Nikkei futures are handicapping what looks to be a down start, softer one as well. Dollar yen 142.22. Now, just 2 weeks ago before we wrap up 2023, and it's been a pretty wild ride for stocks and bonds this December alone. The Dow and the Nasdaq hitting record highs back on Friday after a choppy session of trade. All three major indices have gained 7 weeks in a row now as Treasury yields have pulled back. And that old inverse correlation bond prices, we've seen an epic rally in bonds. Here's the pricing right now as we speak. The benchmark 10 at 391.42. Twos, most sensitive what the Fed does or does not do it for 44.90. So you'll notice where the 10 is as we speak. It's down pretty sharply from about 5%, remember, just only 2 months ago. Investors are betting that the Fed is finally pivoting and will start to ease monetary policy earlier than expected next year. Traders, in fact, are pricing in more than a 60% chance, a two-thirds chance of a first rate cut in March. But, and there's always a but, here it is, the head of the New York Fed, John Williams, Friday, downplaying the pivot talk in an exclusive CNBC interview after the Fed decision last week. Here's a slice of that conversation. Listen in.
It's just premature to be even thinking about that question. Right now, the question that we're thinking about it at the FOMC is, do we have the level of rates right? As Chair Powell said, there's these phases of how we've thought about monetary policy. Have we got this, the stance of policy sufficiently restrictive? And then, of course, we'll be watching the data to make sure that we're getting that appropriate policy. To me, the debate is not, it is premature to really think about what we will be doing sometime well into the future. That's not the question in front of us.
But that's what markets do, right? I mean, they try to forecast what's going to happen 6 months down the road, not necessarily 3 years. So it's not crazy to be thinking, hey, we have inflation has been under control, as you've suggested, and that, as Governor Waller says, and now you've sort of conceded that if inflation comes down, then the funds rate would come down to what? Remain restrictive as you've been, or do you have to be quite as restrictive as you've been?
Well, Steve, as you said, this is what market participants do. This is what commentators do. What we need to do is focus on our job of achieving maximum employment price stability. That's what we're focused on. We've followed a strategy for the past 2 years to make sure first that we got monetary policy to a restrictive stance. Now we're very focused on making sure that the stance of policy is getting the job done. As we watch the data and see how the economy unfolds and how the risks, the balance of risks unfold, we'll decide on what we need to do at that point.
Your primary dealer survey, the last one that was public, there'll be another one public soon, shows that the primary dealers see quantitative tightening ending in the third quarter of 2024. Our CNBC Fed survey found November 2024 at a bank reserves levels of $2.6 trillion, a little bit lower than your primary dealer survey. Is next year a year that QT could end?
Right now, I think what we're seeing is everything working exactly as planned and as intended. We're seeing the balances at our overnight reverse repo facility come down pretty quickly in line with the shrinking of our balance sheet. This is working as intended. Interest rates, market forces are kind of deciding, how, the banks, in terms of demand for reserves, in terms of our overnight reverse repo, that's all evolving, I think, as intended. Now, clearly, we're now down to about $800 billion in the overnight reverse repo facility, and we're watching developments in this market very carefully. I don't know at what point, how things will transpire over the next year. We're focused very much on what's happening in money markets, what's happening in terms of rates and volatility in rates, and importantly, what's happening in terms of our facilities and the level of reserves. The level of reserves is around $3.5 trillion, so we're clearly still in a very abundant level of reserves, and markets are functioning very well. Fed funds rate has been pretty constant within the range. So we're just watching this carefully, and we're going to see how the market, how market evolves here. But right now, it's going according to plan.
John Williams, there, head of the New York Fed, talking to CNBC's Steve Leisman there. Let's bring in Kerry Craig, global market strategist at JP Morgan Asset Management, joining us live from Down Under. Kerry, great to see you. Always nice to have you on the show. What do you make of these comments? Because, we've had Powell dovish and a couple other Fed officials dovish as well, and then boom, John Williams comes out and pushes back pretty strongly against this whole early pivot idea. And this isn't just any Fed official, right? This is first among equals, right? And this is the New York Fed, the biggest buy assets, the most active buy volumes, and the most influential. How much more should we be listening to him, do you think?
Good morning, Martin. Well, I think it's right to say that there's a range of views around the Fed committee members. I mean, you just have to look at the dot plot. They didn't all point in the same direction. They did think that the rate hiking cycle was pretty much done. There was a range around how many rate cuts to come through, but the bias is towards those cutting of rates. I think that the market reaction has been very sharp if we look at how far 10-year bond yields have come down, or the 2-year bond yield has come down, and that would sit a little bit contrary to our own expectations for when rate cuts will actually begin. But I think for investors, the main point here is that bond yields are moving lower, that the central bank is moving away from a tightening policy to a cutting policy. And there's going to be a little bit of trepidation about exactly when that starts. But by and large, that should be positive for both equities and bonds over the course of 2024.
All right. So rates are coming down. That's the main narrative. Do you think the real question then is going forward, the timing, when this all starts? If it's not March, is it, the consensus seems to be sort of gathering around June. Are you there?
Yeah, I mean, it seems to be creeping forward every time you look at market expectations for this kind of thing. And I think it is going to largely depend on the data, and that's a weak answer in terms of how things are moving around. But, you get one employment report or one CPI report that's probably not in line with market expectations, and suddenly those expectations, when that rate cut starts to move. We definitely think it's a back half of 2024 narrative for those rate cuts to come through. We want to see that inflation come down a little bit more in the US, and that the Fed will have more comfort around that disinflation really being built in. And so they'll have more comfort around cutting those rates to come through over the second half of the year. And again, once they do start to cut rates, we think it'll be relatively straightforward in terms of them moving pretty much at every meeting over the second half of the year. They don't really want to have to pause and then take another move to cut rates later. They'll want to keep things in line to give the market confidence that they are heading in the right direction. And also that inflation growth trade-off may become a little bit more apparent. Where the growth starts to weaken enough, they will have to start to cut rates, to thinking about bringing them back towards neutral, or even towards something that's a bit more of a stimulatory case through 2025, as that growth outlook is one for weaker growth across the next year, if not 2 years.
Neutral or stimulatory at the finish, at the end. Is that going to mean as much as 200 basis points in that cycle, the fresh cycle?
Well, if you look at history, 200 basis points move over a rate cut cycle wouldn't be unusual. It'd be roughly average. And so, you could use that as thinking about how far they do go down. Again, I think it comes back to the narrative of the last decade of having these zero interest rate policies, and the use of the balance sheet, as we heard from Williams there, is very much a change in dynamic in our view in the long run. It's more likely that inflation is going to be closer to central bank targets, and therefore those policy rates can be higher than they have been in the past. And I think there's also some structural changes changes in the long run in terms of what drives inflation, relatively moving away from those disinflationary forces of the last decade, which means that investors may be more sensitive to thinking about that stock-bond correlation and really how to diversify those portfolios, because 200 basis points of cuts is still not taking us back to those zero interest rate policies before, and that's a very different dynamic for investors to get their head around.
All right, we'll talk about what investors should do as we continue with Carrie Craig coming up in just a short while. Meantime, let's take a look at geopolitics now. North Korea doing more saber-rattling, firing a short-range missile towards the East Sea on Sunday. Let's get right to Sherry Kang, who has a lot more. Good morning.
Good morning, Martin. And one short-range ballistic missile, it almost sounds benign at this point. It's not an intercontinental ballistic missile, but of course, it's really about the messaging and timing, as always is the case with North Korea's missile and nuclear activities. So the timing of it is very interesting. The anniversary of his father's death 12 years ago, and then it could be a reaction to the NCG, Nuclear Consultative Group meeting that South Korea and the U.S. had just over the weekend. It was the second meeting, and of course, when we're talking about this particular Nuclear Consultative Group between South Korea and the U.S., it's really about a matter that matters to conservative voters, conservative government in South Korea, as well as a North Korea hawk president in South Korea as well. And we did see over the weekend the two countries taking a step forward in terms of building a nuclear strategy that is shared between the U.S. and South Korea. In fact, the latest line that we got from that meeting is that they agreed to complete this establishment of guidelines on the planning and operation of a shared nuclear strategy by the middle of next year. So I think there was something that could have moved the needle on the part of North Koreans. And of course, we did see some reaction, angry one, from North Korea as well. North Korea's defense ministry criticized this, saying that this is an open declaration of a nuclear confrontation. Certainly the idea of extended deterrence from Washington in the Korean Peninsula area could make North Korea very uncomfortable. And then at the same time, there's another element to it. Just recently, just over the last 2 weeks or so, we did see North Korea as well as South Korea abandoning their inter-Korean military pact that was signed back in 2018. Remember, that was when the inter-Korean relations was really cozy and friendly. Well, that's out the window. So I think that is really, showing another example of how complex and very complicated and interesting dynamics that we've got set up for 2024 when we've got general elections in South Korea in April and, of course, the presidential election in the United States in November. Squawk Box is going for a short break here. We'll be right back with Martin in 2.
From here, possibilities are everywhere. From taking first steps here, to beginning your own wealth journey here. From backing global trade ambitions here, to delivering on that promise here. That's why we're here, in the world's most dynamic markets. A bank that connects potential to possibilities. So, where will you go from here?
Sindala Island, our first tourism experience, will open in 2024. Trojena, our mountain resort, which will host the Asian Winter Games in 2029. But when all these major projects are complete, 95% of the land in Neom will be reserved for nature, and already a rewilding program has started with animals being brought back into the environment that there 100 years ago, and 100 million trees been planted as well, which will be done in the next number of years. So a big commitment to sustainability. Within Neom now, we have our own, Neom Film Studios, studios that are dedicated to, the audiovisual production, and already we have seen now some outputs coming through. I think it's going to be a really important part of what we do in terms of telling our story.
He's doing away
complying with Keppel's conglomerate structure and transforming the company to become a global asset manager.
It's a change in the business model where we are going more for recurring income.
On its green energy investments.
We want to be there, we want to know what's happening, but you don't want to be too early as well.
Catch my interview with Lo Chinhua of Keppel on the next Managing Asia.
Welcome back. Monday morning here on Squawk Asia. So we're almost at the end of 2023, but there's still a couple of key earnings and also data points to get through this week before we wrap up the year. CNBC's Bertha Coombs has a look ahead.
The latest read on the health of the housing market, Jeff Bezos' space company looking for redemption, and a busy box office, all in the week ahead. We will see a last barrage of earnings before the Christmas holiday hits, with some key names reporting, including FedEx, General Mills, Micron, and Nike. Some important economic reports also set for release in the lead up to Christmas. Revised gross domestic product numbers are out on Thursday, and personal consumption expenditures will be coming out on Friday. PCE is the Federal Reserve's favorite inflation gauge, measures consumer spending on goods and services. The week ahead will also be full of housing data, with home builder confidence out on Monday, the latest read on new construction coming out on Tuesday, with housing starts and building permits data. Existing home sales come out on Wednesday, and new home sales are set to be released on Friday. Jeff Bezos' Blue Origin space company opens the launch window for its next Shepard payload mission on Monday. It comes more than a year after its uncrewed Fiery failed launch in September 2022. And it will be a busy weekend for movie releases as we head into the long holiday weekend. Warner Brothers' Aquaman and the Lost Kingdom, Universal Animation's Migration, Columbia Pictures' Anyone But You, and MGM's American Fiction, all opening in theaters. Hope you have a great holiday week ahead. I'm Bertha Coombs. Get all of your business news on CNBC.
All right, personally, I'm looking forward to all the movies, new movies. All right, we're back with Carrie Craig, J.P. Morgan Asset Management, still with us live from Down Under. And Carrie, if we could bring it back to this side of the world and talk about China, a huge sort of overhang still, right? And I think you're with the consensus, and that is, okay, they've done a lot of stuff, but they still need to do more, especially on the consumer side. And it's kind of ironic because, I mean, valuations are looking very attractive right now.
Yeah, I mean, that's the one thing that I think is keeping investors interested in China is that the valuation has come down such a long way, even as the economy is yet to find a stable footing. I mean, there was some disappointment around the Economic Work Conference that there wasn't more around a planned sort of stimulus package for the consumer. It does seem like the consumer weakness fed by the property market is the thing that's holding the economy back more broadly. There is a lot being done on the fiscal side, and we expect that to feed through into better growth prospects for next year, but it doesn't sound like there's going to be much more than the 5% growth achieved. That's the official target, given that they're still trying to delever the economy more broadly. I think in the long run, we're still looking towards China and the investing in themes of those policy dynamics that have come through around whether it's the greener economy, whether it's the electric vehicles, whether it's thinking about the ability to be more self-sufficient in some technologies. These are all themes that apply to China. It's just getting a view on when the economy will get back on its feet and see some of that investor flow come through. For now, we think about the global economy and think about where to allocate towards equities. We much prefer the developed markets, given some of the consistency in that earnings coming through. And again, some of the valuation re-rating that may continue to happen as we see bond yields fall.
You know, as far as China goes, Kerry, no expected big political changes for China, at least officially, although, I mean, who knows what happens behind the curtain, right? But officially, we are expecting big political changes, elections in several countries next year. Obviously, the U.S., but also out here, you've got Indonesia, you've got India as well. I know you're getting a lot of questions from clients, or rather, I'd be surprised if you weren't. What are you telling them?
Yeah, it's a very common theme thinking about is the huge amount of the global economy that's covered by elections next year across the democratic world. And obviously the focus is on the US. I mean, thinking back to 2016, people now view what's happening in the US as potentially a repeat of that, thinking about the volatility that may come through. But I think when it comes to the election outlook, whether it's in the US or other markets, I mean, there's still a case of thinking, well, nothing's finished until it's finished. A lot of the polls have not been accurate as they have been in the past, so it's hard to get a true read on what the outcome of any election is. And again, in the long run, it's often that the electoral outcome doesn't have a huge bearing on markets. It can be a bigger shock from an external factor that has more of a bearing. But I think it just adds to that volatility and some of that uncertainty that may be present in the market at the time. And so investors are right to thinking about that appropriate diversification within their portfolios to hedge against that. But I wouldn't read too far ahead in terms of thinking about positioning now for an outcome that may not come, say, in the US when we get to November of next year.
All right. No, that sounds pretty wise to me. Kerry, let's get to the money question, what you're telling clients about that. I know that now is not a time to leave your money in cash. I mean, forget the short end. This is the time for duration, yes?
Yeah, we'd much favour we have quite a favourable view on both equities and fixed income now, given that sort of building idea that you won't see a recession around the world, but we'll have softer growth. Those rate cuts coming through, the fall in yields, it does push you towards fixed income and duration, more importantly, but also thinking about credit a little bit, as we view credit as a non-recessionary asset, and given the yields you get on high yield at about 8.5% on the global high yield index, that carry can be an important aspect of thinking about returns, even if we could see default rates pick up slightly as the economy slows. Even on the equity side, we'd be like bringing down that cash level and thinking more around equities across the developed world, looking for those quality stocks, whether it's across value or growth. We think that that re-rating potential that comes through with lower bond yields will help. And we do think that even with modest growth, you can still see corporate earnings be positive. It's just about the margin question really coming through, and which companies can protect those margins in that weaker growth environment where they still have relatively high input costs.
Kerry, I hear what you're saying about the reinvestment risk of staying cash or short end, right? I mean, as rates come down, you're going to want to lock in what you can while you can. I get that part. As far as equities go, I know you like duration there as well. So we're talking about long cycle businesses, or?
Yeah, there's a strong case for thinking about those secular parts of the market that continue to do well. You know, that is some of the growthier parts that may have seen valuations move higher. I think most of our investor client conversations we're having now are really about thinking when to rotate into some of those lagging sectors and whether there'll be a stronger catch-up come through. You can look at the small cap performance most recently and have questions about whether that would continue. I think there's still a debate there. We are going to pick out the quality side in terms of thinking about companies that have, adequate cash balances that can defend themselves, thinking about those companies which generally still have pricing power, which is a little bit harder to defend when inflation is falling rather than inflation is rising. And also being aware that there's potentially some downside risk to the economic outlook should, the Federal Reserve or other central banks really get this wrong in terms of having those policy settings too tight for too long, and some of the cracks that are starting to appear around the consumer as well. So we're going to still be a little bit defensive in that positioning rather than thinking about full-on risk in equities. And we are going to lean towards the US still, given its quality bias, and also towards Japan, because we think that's a stronger case for a bit of nominal growth will feed through into earnings returns as well.
Oh, interesting. Kerry, when we talk about rates starting to come down, right, that usually drives risk on. And I want to make sure I heard you right a couple of seconds ago. You're saying you like high yield despite the default risk. And are you talking about EM high yield?
No, I'm talking about developed market high yield. So it's all about the carry and the fact that you are getting a lot more around the income that comes from that, and that being a pretty good cushion. So you see some of those default rates start to rise. I mean, they're only just sort of creeping back towards that 2% level now, so they could certainly move higher. But again, it's a non-recessionary asset. If there is a case of not thinking about a recession, you're going to pick up that carry, and you could see spreads remain relatively well contained, or not at least blowing out to the sort of 700 or 800 basis points you may have seen in the past. And again, it's that compare that to the equity side of things, where we still have some concerns as well. Maybe you prefer to take some of that equity-like risk through the high yield market rather than thinking about just moving into equities more broadly.
Gotcha. All right. Kerry, listen, always great value talking to you. Appreciate the time. Very useful. You keep safe. Happy holidays, and we'll see you again very, very soon. Kerry Craig there from J.P. Morgan Asset Management joining us live. All right, here's a look at how Australian miners are doing so far this morning. I've got most of them under a bit of pressure, except the Woodside. Woodside is up 0.1%. The rest are to the downside. BHP, the big one, off by a quarter. Rio Tinto by a bit more. Fortescue down by more than a third there. And this is on the back of the Australian government coming out with its adjusted outlook on commodity export earnings earlier this morning. The country's expecting earnings to hit 408 billion Australian dollars through the fiscal year ending June. A little bit better than earlier forecast because of stronger global growth and also more steady demand from China, which is, of course, Australia's largest trading partner. Overall, the earnings are set to still fall significantly from last year, and the government expects even further declines in the next fiscal year. We're going to take a quick break. We're back in 2.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 26 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
People are really excited about the sport and where it's going.
The US has gone crazy and has woken up to what Formula One is.
It's about fastest man and fastest machine wins.
So this is Lewis's car.
This is Lewis's car, number 44.
Can you put a price on the cars?
They cost about $50 million to develop.
Our business today generates about $600 million in revenue.
A CNBC documentary, Inside Track, the business of Formula One.
We have the luxury of being incredibly well capitalised. We have about $10 billion in excess of our upper operating ranges and more than $22 billion more than our supervisory minimums. The beauty of our franchise globally, with a strong presence in Asia and strong franchise with our wealth and asset management business, is that we've got a lot of organic opportunities. So we will look for opportunities inorganically. Organically deploying our capital will always be our number one priority, as will providing dividends for our shareholders.
Our world is moving faster than ever before. There's an opportunity to build a better financial system for our future, advancing economic progress for all by modernizing markets, unlocking access to capital, and fighting financial crime. Because we believe today is another step forward in our relentless pursuit of a better world, accelerating your journey to rewrite tomorrow.
Invest with an advantage with CNBC Pro. Exclusive access to investing experts and analysts, customized tools, wealth management, and investment strategy. Plus, actionable analysis of global market coverage and the biggest names in business and investing. Become a smarter investor. Become a CNBC Pro with an exclusive offer for a limited time only. Go to cnbc.com/pro offer now.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech on CNBC.
What was my ambition when I was starting out? Survival. Grew up pretty rough, and we ended up homeless when I was in high school. It really motivated me to have a career in which I wanted to have an impact in people's lives. Art is bold creativity, bringing your visions to life. My dream for Kickstarter is that anybody with an idea can bring it into reality. If I can do it, I want to show other people that they can do it too. I just want to bust the door wide open for everybody that looks like me.
CNBC. Live ambitiously.
Time check, 7:30 a.m. Hong Kong, Singapore time, so less than 30 minutes to go before the market in Tokyo opens up for a fresh week of trade. Futures are handicapping. Looks to be a down start. Dollar yen at 142.25 or thereabouts. We've got South Korean markets opening at the same time as Tokyo. Sherry Kang, how are we shaping up today?
Yeah, so looking at the ETF, we did see a bout of volatility on Friday, must point out, also on Wall Street as well as on Friday session in South Korea, given the options expiry. And we do see that negativity seeping through when it comes to that EWY here. But of course, we did close out the week on the Kospi with 1.82% of gains last week, all that post FOMC rally for sure. And looking at the Korean won, a little bit of a calm as well. 1300.40 is what we're looking at when it comes to the Korean $1 cross. But of course, today or this week, we care about the BOJ. So let's flip out the board and for a change, take a look at the yen versus the Korean won. We certainly see the yen has been coming back up over the last month or so and currently going at 9.1397. When it comes to South Korea specific stories, I care about capital gains tax. Yonhap News Agency is reporting that this week we might get some details about capital gains tax, especially in the stock markets. And of course, this could be potentially a trigger point that could actually extend this year-end selling spree or buying spree. I don't know. It's not very clear how the market is going to read this, given, of course, we don't really know the detail of it and the extent of how the government is going to go for it. But of course, we might be seeing some kind of, complex dynamics playing out in the markets combined with the effect of a short selling ban. Of course, that was announced a couple of months ago, but we'll be watching security stocks as well. And then cabinet reshuffle continues in the lead up to the April general elections. We did see the presidential office actually replacing the industry minister with the current trade minister as well. Martin?
All right, Sherry, stay right there. As we close in on the end of 2023, we're taking a closer look at some sectors that saw a lot of action this year. And Sherry's been all over one of them, which is EV batteries, really hogging the limelight in South Korea. The Korean government capping off a year of surging interest in EV batteries, announcing a $29 billion financial package last week. The aid will be dispersed over the next 5 years. Its objective is to help local battery makers better diversify their supply chains and comes after the U.S. moved to limit tax breaks for companies that rely on EV materials from, well, China. Let's bring in Nikhil Bhandari, co-head of Asia Pacific at Goldman Sachs. Sherry, part of the conversation as well. Nikhil, good to see you and appreciate your time. Is $29 billion for South Korean EV bat makers, is that enough of a carrot to wean them away from sourcing from China?
Look, I think, in our opinion, the growth in the EV market, including the U.S. Demand, will be more driven by economics and less so driven by the support from the regulations and subsidies. If you look at lithium prices, they're down about 75% from the top. We think there is more to go. On top of the lower raw material prices, we are seeing more simpler cell-to-vehicle integration and more commercialization of innovation. So that's all driving a rapid decline in battery prices below $100 per kilowatt hour by 25, leading to a cost parity of EV with ICE car without subsidies, even in the U.S. market. Now, coming specific to your questions, we are actually seeing a fast, rapid localization of the supply chain in the U.S. market with the help of the Korean battery maker. We think Korean battery makers will be over 50% of the U.S. market with the rapid localization there. And the self-sufficiency in the cells and key component like cathodes can arrive by 2026 in our view. Now, there are certain parts which are difficult to replicate immediately away from China in the US market. That includes things like anodes, but otherwise cells, cathodes, and some other components like separators and electrolyte. We're seeing a rapid localization, partly with the help of Korean supply chain, and that is gradually more and more economics driven.
Economics driven, Nikhil. So let's get to to exactly that. You'd agree that the key thing for EVs is the bat, still the most expensive component in any EV, right? And so how much it costs to make an EV bat is extremely important. You mentioned prices coming down. Put some numbers on that. You and I were talking offline a couple of seconds ago, and I asked you, I mean, what is it now? And you said about 150 kilowatt hours. What is it set to drop to?
Yep. So we are expecting battery prices to drop to $99 per kilowatt hour by the end of 2025. This is driven by, as I mentioned, a combination of raw materials decline, like lithium, which is down 75% from the top. Lithium has come back from a deficit market last year to a surplus this year, and we think it's going to be into a bigger surplus next year, equivalent to 17% of global demand. Now, lithium prices, even after the decline, are still nearly 30% above the top end of the integrated producer's cost curve. On top of that, we are seeing more simpler cell-to-vehicle integration, for example, better packaging, elimination of modules in between the cells, more commercialization of larger size cylindrical cells like 4680. You layer it up, the raw material decline with these innovations and simplification in the structures. We're expecting battery prices to be at $99 per kilowatt hour. $100 is the magic number below which we think the parity arrive for EV and ICE cars, even without subsidies.
Nikhil, this is Sherry jumping in. You remain positive on U.S.-focused Korean battery makers, and of course, they have benefited greatly from the Inflation Reduction Act so far. I just want to get your read. Was it hawkish or dovish or yet to be determined from what we got from the U.S. guidelines on the foreign entity of concern, of course, as part of the Inflation Reduction Act? And what does that mean for South Korea's battery space?
Sure. Thank you, Sherry. So, look, we see the new guidance on FEOC, foreign entities of concern, as broadly in line with the industry expectation, which has been largely anchored upon the definition of the CHIPS Act, which already came out some time ago. Now, notably, the requirement is more to meet the clean car credit, which is $7,500 that goes to the consumer. But the Section 45X subsidy of advanced manufacturing tax credit that is directly going in the pocket of the battery maker, for example, from Korea, is not affected in our understanding. So those subsidies are not subject to the localization of supply chain. If I'm a cell maker and putting up a cell plant in the US, I should be getting the advanced manufacturing tax credit. That is equivalent to roughly 30% of ASP of the batteries. We think that is critical to protect the Korean battery makers on the cost curve from the China competition. Accounting for these tax credit, we think locally made batteries from Koreans in the US will be more cost effective comparing to importing the batteries from the China market. And secondly, as I mentioned, the US market demand eventually will get more economics driven as well. It doesn't matter if we buy the metals in US or China or Korea, as long as the raw materials are coming down, which is 60% of the cost of battery. Together with these advanced manufacturing tax credit, the setup of the Korean battery makers should continue to be market share and margin accretive in the US market.
So within South Korea, you like LG Chem, LG Energy Solution, and Samsung SDI. Why not SK On? And what would be the right time to get back into this space after, of course, a little bit of correction this year?
Sure, I'll probably stick my, in the interest of time, broader comments at a more sector level. But if it helps, our preference in the space has been driven by battery makers who have focused on three aspects. One, the battery chemistry diversification. We don't know what batteries will look like 10 years later, but those who have long-standing experience and are trying to produce a wide variety of battery chemistries and form factor, we think will be relevant, whatever the batteries look like 10 years later. Number two, we are focused on supply chain control or vertical integration. There are 10 or 15 things going inside the battery. We think the winners we have a high level of vertical supply chain control. And third factor is the location. We think U.S. will be best positioned from a battery supply demand perspective and more resilient from the China overcapacity driven surplus. So from those perspectives, we have identified the winners in the Korean battery space.
Nikhil Martin here, very quickly before we let you go. You're talking about battery chemistry. The next big thing could be sodium, could be potassium ion, etc. But, a leap further than that, of course, is forgetting the liquid catalyst totally going solid state, which is something that the likes of Toyota, also Nissan, are making a lot of noise about and saying, look, we're going to be able to scale this in probably 2-3 years. How significant would that be in driving affordability and bringing the price down?
Sure. We think solid-state battery is the game-changing technology. Several companies are working on it, as you mentioned, companies in Japan, but also in Korea. And there are several startups, especially in the U.S. market. We are still at the early stage of the commercialization of the solid-state battery technology. While we can crack the solid electrolyte part first, which can happen in the next 2 to 3 years' time, that means the solid-state battery with high range of kilometer per charge will be there, but it's going to be very expensive. So we think the solid-state battery by the end of this decade will still have a very small market to cater to, a very high premium car market, because these batteries will be much more expensive. To have a cheaper solid-state battery, we need to crack the liquid metal anode, which is still an early 2030s commercialization story. The later part of this decade is more a solid electrolyte part, which cracks the range, but not the cost. To have the cost cracked as well, we need liquid metal anode, which is early 2030s. So again, it's going to be a game changer. Everybody's racing for it, but it's still a bit far out.
Yeah, so about a decade away, sounds like. Listen, Nikhil, fantastic talking to you. Great. Thank you for your time. Appreciate it. Keep safe. Happy holidays. We'll see you again very soon. Nikhil Bhandari there from Goldman Sachs. Sherry Kang, part of the conversation as well. All right, coming up next, time for a weekly travel segment. We'll bring you travel tips, trends, also concerns as we head into the last big holiday of the year. More when we come right back after this.
On a $100,000 margin loan, Interactive Brokers charges just 6.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade and TD Ameritrade are even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
Safety feeling and emotional feeling. Azerbaijan was always a safe destination, is continued to being a safe destination. As an Austrian living there for 12 years, I'm the best guaranteed that any traveler is safe to move around.
Everybody wants to go somewhere where they're safe. Seychelles is a safe destination. We set up not long ago a tourism police unit just to make sure that visitors, they can have their peace and tranquility.
Safety is of most important for Peru. We have a system that's called iPeru. It's a platform there. It's available for travelers. In case of emergencies, there is a WhatsApp number they can contact 24/7. A unique way for travelers to feel safe.
CNBC puts the sustainability agenda on center stage at the World Economic Forum in Davos.
To discuss the most urgent issues of this post-pandemic world.
How can businesses meet sustainability goals while surviving a global downturn? The changing workplace and the speed of generative AI.
And charting a path for climate action.
Tune in at cnbc.com/Sustainable Future Forum
to watch exclusive analysis and discussions.
CNBC Sustainable Future Forum, January 16th.
Welcome back. It's a Monday here on Squawk Asia. Airline rankings often examine the finer details of flying, from the quality of airline food to in-flight entertainment. But some of them, though, overlook what one passenger rights group calls a crucial component to customer satisfaction, which is how an airline deals with problems that happen on the ground. CNBC's travel editor Monica Petrelli joins us this morning with more. Good morning.
Yeah, good morning, Marty. So, many of the world's top-ranked airlines have really mastered the art of flying, from booking to boarding to the time spent in the skies. But not all of these airlines have the greatest reputations when it comes to how they handle passengers' claims. I'm talking about when problems arise, like luggage gets lost, or for delayed flights or canceled flights. So, the passenger rights company AirHelp releases an annual ranking that does just that. They look into 3 factors. They look at on-time performance, customer surveys, and how efficiently airlines handle customer compensation claims that are valid. So this year, the ranking was released just this month, showing that Qatar Airways is in the top spot. Now, this is a place that Qatar has held every year since 2015, but for one, and that was in 2016 when Singapore Airlines knocked it to number 2. But following that, we see Eurowings, which is a subsidiary of Lufthansa, Polish Airlines, and then Etihad and All Nippon Airways in a tie there for 4th and 5th. But if we look at the bottom of this list, well, we see here Tunis Air, the national carrier of Tunisia, coming in dead last, followed by British Airways, Frontier, and Pegasus Airlines tied there for 3rd and 4th, and then Czech Airlines. But if we isolate this issue of how airlines handle customer compensation claims, well, we see a different list emerge, one dominated by China Airlines and Brussels Airlines in a tie there for number 1 and 2. And then followed closely, just a 1/10 of a point, I might add, is United, SAS Scandinavian, and then Air Baltic tied there. But faring the worst in terms of how an airline handles passenger claims, well, that's British Airways with a score of 1 out of 10. Now, the CEO of AirHelp saying British Airways is a large, popular airline, probably handles a lot of claims, and is likely understaffed. Now, I did reach out to British Airways for comment on this story. They told us they're working hard to improve response time. They've hired 1,500 additional employees to help with this issue, and that most claims are managed within 7-week time frame. Now, if you're looking and wondering where your favorite airline is on this list, well, you can check out a story that we published on CNBC.com earlier today. It has more details as to airlines and also all the scoring that AirHelp gave these airlines. Now, Singapore Airlines, Marty, a fan favorite in this neck of the woods, coming in number 26 on this ranking. Wow. And that was because it was dragged down by this customer claim compensation issue. Also, Emirates, another favorite, coming in at number 24 for the exact same reason.
It's kind of surprising, right?
Yeah.
But, broadly speaking, the challenges that airlines are going to face on the ground going forward, with climate change, El Nino, et cetera, flight cancellations, they're probably going to have to up their game on that.
That's exactly right. That's what the climate issue is, a big one. And we know that many scientists are saying that not only just the dreaded winter weather, but now we're seeing what happened last summer. And so I think the cancellation issue will become a bigger issue. Now, I asked AirHelp CEO, I said, a third of this ranking is on this issue of how airlines handle customer compensation. And I said, why give it this much deference? They said it matters. It's a matter of customer loyalty. It's a matter of airline reputation. If you're battling these claims for weeks, months, I know one time it took me a year to get compensation back from an airline that was statutorily required under the EU. Will this affect how you and where you book the next time? Yeah, likely so. And here we are.
If I had to wait like a year for my money back, right? Goodness.
I couldn't believe it, actually.
Yeah.
I had thought that it was a done and over deal. And you do feel sort of helpless, which is why I feel that AirHelp comes in. But, here we are sitting right on the precipice of a major travel season, Christmas. It's expected to be a massive one, bigger than 2022, according to surveys, and potentially bigger than 2019.
Okay, let's dig down and bring in Tim Henschel, co-founder and also CEO at Hotel Planner. He joins us now live out of London. Tim, good to see you, and thanks for staying up to do this with us. I know it's very early where you are, getting up so early to do this with us. I know it's very early where you are. Does that pretty much describe it for your business? Booming right now?
Yes, business is definitely booming in travel. I'm actually in Oslo, Norway right now on a ski vacation. And my flight was completely packed, but they got us here smoothly on time. with Scandinavian Airlines. And I just got back from Singapore, and Singapore Airlines was another packed flight, but, very smooth. As the industry's going, we're forecasting 2% up in demand. We have RevPAR is going to be up another 5% from all-time highs. So the industry is very healthy right now. We're hitting record revenues in both airlines and hotels right now.
Tim, I want to ask you, we're seeing some flight prices come down somewhat, but we're not seeing the same with hotel prices. What can you tell us about how, what we can expect from 2024 hotel rates and how passengers are really spending their money right now? Or not passengers, really hotel guests, how they're spending their money?
Yeah, so luxury travel right now is at an all-time high. I think that has a little bit to do with the rising interest rates. High net worth individuals are, flush with cash right now. And with interest rates rising, obviously they have more disposable income. So there's a huge rush out there for all things luxury. 5 stars going higher and higher. Where you find bargains is in the 1 and 2 star categories. Demand is actually down in 1 and 2 star hotels. So if you want to travel with the celebs and the elites at the 5 and 4 star level, those rates are going to be high because demand is at an all-time high in that category. Trends we're seeing right now is something like set jetting. This is new to follow actual celebs and shows that are filming on location. So Paris is booming because of Emily in Paris. And right now they're shooting White Lotus in Thailand. So Thailand is getting huge demand. And of course, when they just filmed White Lotus down in Sicily, Sicily saw huge demand spike there too. So experiences, the baby boomers that have, huge high net worths right now are looking for those experiences and are spending for big travel dollars.
And if we talk about deals, everything shows travelers want these deals. I'm not finding it too easy to find them, but as you just said, the 1 and 2 star hotels may be the place to go. But what else can we see as a way to sort of save some money next year for travel? Maybe places like emerging destinations or shoulder season travel. What do you recommend?
Yeah, absolutely. Secondary cities obviously are jewels out there. As an avid traveler myself, and I'm sure as you are too, we get to major cities all the time for conference and work travel. So taking your vacation off the beaten path not only is more exciting, but it also could lead to nice savings. So looking for tertiary destinations that are less crowded, less traveled to. I mean, I'm actually here in Trysil in Norway, which is less known than the Alps. I didn't even want to say Trysil because it's my 4th season here and it gets more and more busy every year. And so now that I've said it on TV, maybe more people will be coming here and I'll have to find another, secondary ski destination. But yeah, just to look with AI out there right now, it's easy to consult AI for these secondary popular destinations. And, you see some exciting options and check those out because the rates are more affordable than major cities.
Speaking of AI, I've seen some stats saying that a hotel planner has had 1 million ChatGPT queries. Can you tell us exactly how you're using AI? I know a lot of people talk about, it's really helpful, people are using it, but what exactly are you seeing people use it to do?
So we have a robust call center for people who want to call in and ask questions. And from that call center, the questions are actually fed into AI ChatGPT, and those answers are given to our agents to help them with their agents. So think of an AI human hybrid, and that helps travelers get the best responses as quickly as possible. So yes, over 1 million ChatGPT requests in travel.
All right, Tim, listen, we got to go. Fantastic talking to you. Enjoy skiing in Norway, and happy holidays. We'll do it again very soon, I hope. Tim Henschel there, CEO at Hotel Planner, joining us live. Pleasure's ours. And also my great colleague, Monica Petrelli, part of the conversation as well. All right, so we're going to take a quick break. We are back in 2. Don't go away.
CNBC looks at ways of making your money work for you. We'll explore how to use your wealth to further life's most important goals. Is it just as simple as putting money away?
Now inflation is falling, you can earn higher than inflation on cash.
How can investors protect themselves against the cost of living crisis?
Equities is the best instrument to use to beat long-term inflation.
Activating Wealth on CNBC.
Activating Wealth, sponsored by Standard Chartered.
He's doing away with Keppel's conglomerate structure and transforming the company to become a global asset manager.
It's a change in the business model where we are going more for recurring income.
On its green energy investments.
We want to be there, we want to know what's happening, but you don't want to be too early as well.
Catch my interview with Lo Chin-hua of Keppel on the next Managing Asia.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 26 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Global markets up to the minute. Front page news. Frank Holland gets you ready for the day. Worldwide exchange.
Keep up with the crisis. Understand what's moving and why.
I need Carl to translate Kramer.
Squawk on the street.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
Being the first woman engineer at Google, I got asked all the time, what's it like to be a woman in tech? And I realized that I didn't feel like a woman at Google. I felt like a geek at Google. It was the passion around what we were doing that really, for me, neutralized the notion of gender, which is why I like to say passion is a gender neutralizing force. To me, ambition is being undaunted by the impossible. I've been really lucky to work at two companies, Google and Yahoo, that really fundamentally changed the world.